Hello everyone, our group is going to do the presentation of SME capital raising through finance companies. Firstly, I will do the introduction part. I will explain what's small and medium enterprises, and then I will explain what's finance company. Secondly, Chujing Zhang and Joseph will do the body part. Chujing Zhang will introduce the assets for small and medium enterprises to raise capital, and then she will explain how to raise capital for small business. Joseph will focus on debt financing through finance companies, such as commercial banks. He will explain it in three aspects: permits, risk, and return. Then, Joseph will introduce the benefits of debt financing over equity financing for small and medium enterprises. Finally, Qian Li will do the conclusion, and she will give us some recommendations for small and medium enterprises to raise funds through finance companies. Let me explain what's small and medium enterprises. It's important for us to know that different countries might have different definitions of small and medium enterprises. Small and medium enterprises refer to businesses whose personnel numbers fall below certain limits. Generally, they have small revenue, small profit, small number of employees, and small in size. Then I will explain what's finance company, and I will give some typical examples of finance company. Finance company is the financial organizations that accepts deposits and payouts of interest on them and lends to consumers and business to generate interest income. Financial company profits from interest margin. Finance companies include commercial banks, financial intermediary, institutional investors, lending institutions, and loan portfolio. Then, let's welcome Chujing Zhang to introduce the assets for small and medium enterprises to raise capital.
Like our business, raising and securing a solid capital base presents a huge challenge to small and medium-sized enterprises. Financing options contains two static rates: debt financing and equity financing. The former is the method of financing in which a company received a loan and gives its promise to repay the loan. It includes both secured and unsecured loans. Debt financing can be largely grouped into two main types: long-term and short-term. They differ largely in terms of their level of risk to the company and the cost of service. Overdrafts and bank loans are the most common types of debt financing. Equity financing that this involves, but it is not limited to, obtaining financing from potential investors, family and friends, or ensuring IPO. Equity finance enables the generation of share capital from external investors in returns for a share of the business. It often eliminates the hassle of the debt repayment and interests associated with debt finance. The level and the type of demand for financing throughout an SME's life cycle depends on its stage of growth, as each stage requires a different financing strategy. This approach enables the business to grow and reach the capital market, where it can raise long-term financing and sustain its growth. But how to raise capital for small business? To raise the capital, first, raising equity capital by means of capital markets offers access to capital via an organized, transparent, and orderly function reliable market. And secondly, SMEs generally have limited access to venture capital and debt funding. particularly at the early stage in their life cycle. In order to promote new areas of growth and move towards an innovation economy, there is a need to strengthen new avenue of financing to support the innovative firms. And thirdly, in terms of efficiency, raising equity capital may involve a longer process, which compared to other financing options, it may also require a greater initially outlaying of costs and involve ongoing regulatory and administrative requirements.
Debt financing through finance companies such as commercial banks. Premise for small and medium enterprises raising capital through debt financing. Financing companies use a process of giving a wealth of money to SMEs on the premise that these SMEs will pay a periodic interest payment back to the bank based on the debt received, and also a periodic principal repayment or a full payment on the foreclosure of the debt whenever that may be. Risk involved with SMEs using debt financing as a way of raising capital includes such things as bankruptcy costs and the chance of bankruptcy. This occurs when the business can no longer pay their immediate debt, which includes such things as loan payments, e.g. interest payments, and principal repayments. In the case in which this happens, the SME will go into foreclosure and the bank will start seizing their assets in order to repay the loan. In this case, the business will experience the costs involved with bankruptcy, which includes such things as the seizure of operations, which means no more profit, and the devaluing of assets in order to sell them fast to repay the bank. This is disadvantageous for the SME. The return involved with cap raising for SMEs through debt financing are the potential benefits from leveraging. The potential benefits from leveraging include such things as increases in growth as a result of the injection in wealth from the loan. This increase in growth causes businesses to have the ability to increase their profit and increase their capital gains, which will increase their total equity. If this increase in total equity outweighs the expenses involved with debt financing, which are the interest payments and the principal repayment, then the net equity for the firm will increase, and as a result of this, the wealth of the firm will increase. A benefit of debt financing over equity financing is that the business may have the ability to write off some of their tax as a result of the debt repayments, e.g. the interest paid on that debt may be written off and tax deductible.
In the presentation, my partner Yuchen has made definitions about small medium enterprises and finance companies, and Chujing introduced the three axes to raise money from finance companies. Then the Josephi classified the small medium enterprises using debt financing through commercial banks. Also, small medium enterprises play an important role in economics. Their access to finance is limited and has been a challenge for policymakers globally. There are three recommendations for small medium enterprises raising money from financial companies. The first one is improving market liquidity for small medium enterprises securities. We recommend that wherever possible, policymakers should introduce a market-making system for securities issued by small medium enterprises. The second is policies should encourage the issuance of securities through private placements, help improve small medium enterprises' access to capital markets, and such measures should be introduced by policymakers to facilitate small medium enterprises' ability to obtain funding from the capital markets. The third one is the private equity, venture capital, and securitization can be effective tools for financing small, medium enterprises. That's all our presentation about small, medium enterprises capital rising through financial companies. Thank you for your listening.